Hey everyone, this is Shri. Today we are going to talk about the topic financing and capital budgeting a small business. Starting a small business, it's not an easy job. It does require a lot of planning and also taking care of appropriate things. So today we will talk about what are the primary things need to be done if you wanted to start a small business. The first thing is create a business plan. So, as part of the business plan, you'll be identifying the idea and your objective of the business, and you will be identifying the opportunity cost, whether to invest in a business or invest somewhere. So, once you decide, okay, yes, I wanted to start the business, then you need to select the type of organization. And once you select what type of organization it is, um, it could be partnership, it could be S corp, it could be C corp. So it can be any of this partnership, right, or any of this business type. So once you select the type of organization, then you need to look at the capital perspective. So how you can raise the capital? What are the various mechanisms? Debt versus equity, right? So those are the next things needs to be analyzed. And then once you found a way to raise the capital, the financial statements, basically the projections, right? History and projections need to be evaluated to validate whether the business can be successful. So, as part of financial statement, you will look at income statement, you will look at balance sheet, and you will look at the cash flow statement. And these can reveal the profit and the loss. The next is the break even analysis, right? It's basically identifying at what point you will recover your capital. So you're investing your capital in a business. After a certain period, you will start to see the profit. So that is what is called break even, and this is break even analysis. The next thing is time value of money. So it's primarily if we have $10 today, the value of the $10 after 10 years won't be the same. It is going to be different because of the inflation and interest rate. So we will discuss what is time value of money and how it plays important role in the capital budgeting. So let's jump into the next one. Creating a business plan. So creating a business plan is primarily, first thing is you need to have an idea of what is the project or product you're going to create and with the clear objectives. And the second thing is identifying the target market, analyze the competition, and then what is your competitive advantage of your product or your project. Once you understand where you can succeed, then you need to analyze your strength, weakness, opportunities, and threat. And how can you use all of that in an efficient manner to overcome your weakness or to overcome your threat? As you find out the SWOT and everything, the strategy on the marketing strategy and everything, the financial strategy and financial budgeting and forecasting plays an important role as well. So we will take a little bit more deep dive into the financial planning, budgeting, forecasting, and the next step is capital budgeting. So we'll look into all of those steps a little more in detail. So the next thing is, yes, you have decided you wanted to validate whether you want to start a business. The first thing you need to do is what type of um, business entity you're going to start, right? So there are different kind of business structure: proprietorship, partnership, LLC, C corp, S corp, or non-profit. And depending on the type of business structure, your liability and your risk or the amount of taxes you need to pay and your ownership, all of those going to change, and some of them could be advantageous while others could be causing disadvantage. For example, in case of proprietorship, it's one person can start it and very easy to set up, but it's going to be coming out of your pocket. It's a personal tax. In case of partnership, it is primarily multiple persons, and again, this also has unlimited personal liability. In case of LLC, however, the things are a little different, right? Here you have one or more person, but the person is not completely liable. The risk is reduced. They do have limited liability, right? And tax perspective, there is self-employment tax, personal tax, or corporate tax. All of those needs to be paid. Next is C corp. C corp is the many companies which are completely public, right? It can be one or more person, limited liability, no person is primarily liable, and the taxes perspective, it's corporate tax. And what are the pros of this, right? It can, because of the stock and shares, right, unlimited access to the financial capital. But what's the cons? It's primarily double taxation, and primarily because it is a corp, a publicly offered stock, right? So there will be a lot of documents, financial statements, and auditing needs to happen, and it needs to be submitted to the government. In case of S corp, again, it is one or more persons, but there are a lot of restrictions on S corp. It can be only started in certain state, and also the maximum can be 100%. Again, the advantage here is there is the person is not fully liable. And taxes perspective, so here they don't need to do the double taxation. It's primarily the personal tax, and there is no corporate tax. At the another another business structure is non-profit. So since it's a non-profit, it is primarily focuses on some cause, right, which could be political cause, it could be environmental cause, it could be something related with a social cause. So once you select based on your business needs, you can select the type of entity. Then you need to think about, okay, when you want to start a business, what are the type of capital we can raise, and how can we raise the capital? So when you think of capital, it can come in two flavors, right? One is debt, another one is equity. Debt, primarily you can get it from any banks or other private institution who can lend the money, and you will be paying an interest. Whereas in case of equity financing, we will have investors and grants and venture capitalists from various places. So as you see here in the graph, right, so primarily this is the kind of this picture shows how a corporation starts all the way from idea and finally growing and generating revenue. So if you see there, the first initial portion, which is the seed startup section, where there is a valley of death, right? Because before the product is completely launched, it is going to be a lot of expenses, and there will not be any revenue coming out. And then the next stage is the early stage. During this stage, the angel investors will be investing in, and there will be super angels as well. As it grows further, right, so then it goes to the expansion stage and then later stage, and finally when it hits the IPO, so and then after it hits IPO, it is ready for going to the public market. So on this picture you can see at different stages different kind of investors are playing a key role. Okay, so let's consider now we have the capital. So how do we wanted to find out how much we wanted to do the how much income we are going to generate, right? So or what is the income based on the past? So the income statement can be for the past, or it can be a forecast. So in our case, for example, here in the picture we show the historical period as well as a forecast for the next coming 4 years. An income statement primarily focuses on the profit and loss statement. So it does have sales at the top, and then the cost of goods is primarily subtracted from that. And once you have the gross profit, which is primarily the revenue minus COGS, So you will have operational expenses as well, which is primarily salaries, rent, or property tax, etc. And after that, this also includes other expenses as well, which is primarily interest and tax. And at the end of this income statement, you will see the net earnings. One problem with this income statement is it does not tell how much sales has been made in cash, because the income statement will tell if something is bought on credit, it will still show it as credit, but it may not be the real cash you have. So the next second is a balance sheet. So in case of balance sheet, you can find out how much you have the equity, or how much is the overall your asset value. So the asset value is primarily two categories of asset. One is current asset, which is like bank accounts, AR, inventory. The second is a fixed asset, which is primarily land, building, and equipment. The next section is the liabilities. Liabilities primarily are again categorized into two. One is current liabilities, the second is a long-term liability. So once you have the asset and the liability, and when we subtract asset minus liability, we get the stockholders' equity. Another important financial statement is cash flow. So in case of cash flow, right, this is the statement which can provide information about what is the real cash available based on the liquidity. So, and the income statement, even though income statement talks about profit and loss, it will not tell about the cash flow, but primarily this document can help this. The input for this statement is the net income, primarily from the income statement. And then on top of that, net income, this includes cash flows from the operating activities, and which includes depreciation and the increase in AR, AP, or increase in notes payable, increase in taxes payable, etc. And finally, towards the end of this cash flow, we will find out the cash balance and net increase in cash. So as we finished all our financial statement, we are able to analyze, and also we are able to forecast. This can give an idea of, okay, what is the profit, or what is the loss, or what can be expected in the upcoming years. But if you wanted to know exactly when are we going to start to generate the revenue, so we need to do the break-even analysis. So the break-even analysis primarily plots. It's a chart. It plots the units sold, or it's basically the how much. It can be categorized or depicted in two ways, right? Break-even quantity or break-even dollars. Break-even quantity is fixed cost, which is equivalent to the amount of units sold for the contribution margin. The break-even dollars shows the revenue required for the break-even point. So when it is break-even, then after that the startup will start to generate more revenue. So if you see in the graph, the right hand side is more of an profit area, but if you see the left hand side, it is more of a loss area. So here the break-even quantity and break-even dollars can be calculated using the below formula. So the next is leverage. So the fixed cost primarily that magnifies the return to the company. So there are different kinds of leverage: operational leverage and financial leverage. The operational leverage can be calculated using the formula, and similarly financial leverage can also be calculated using the below formula. So once we figure out all these, and then we need to measure how our business is doing. So when we want to measure how our business is doing, we have so many different measures based on the need. For example, if we want to validate the liquidity ratios, basically the cash available on hand or easily accessible. So the current ratio and quick ratio can help. The second is activity rates, how efficiently the business is doing. So it's primarily inventory turnover ratio, total asset turnover ratio, fixed asset turnover ratio. The third category is leverage ratios. Primarily, it covers the debt to finance equity ratio, debt to total asset ratio, and then the time interest earned ratio. And then now we talked about leveraging, activity, etc. But here comes the profitability. So when you wanted to measure how much you are profitable, you can use the measures such as net profit margin ratio, gross profit in margin ratio, operating profit margin ratio, net return on asset ratio, return on equity ratios. And then the next category, which is primarily the market rates. Here it comes compare the firms in the same industry and how they are doing better. So the changes earnings per share ratio, price earning ratio, operating cash flow per share or free cash flow per share, these can be used to derive the market ratios. So now we are able to measure how our business is doing. Next, what do we want it to do? So we need to do the capital budgeting. But before we jump into the capital budgeting, one of the concepts we need to understand is time value of the money. So as I mentioned earlier, a $10 today does not equivalent to $10 in 10 years. So due to the inflation rate and the interest rate. In US, the annual inflation rate is approximately 3% for the last decade of years. And to calculate this time value of money, we use the metrics such as internal rate of return, annuity due, and these can be calculated using the formula mentioned over here. So for example, the effective rate of return, and similarly future value of a lump sum or present value of the lump sum. So all of these can be calculated using the formula. Next comes the capital budgeting. So in case of capital budgeting, primarily it's more about evolution of product or project, whether to continue or not, or whether to invest in or not. So this analyzes the cash flow and inflow and outflow and find out the expected benchmark. And here you would see there are primarily 4 different categories, which is internal rate of return, and then accounting rate of return, payback analysis, net present value. Okay. And finally, the conclusion. So here, as you see, so starting a small business needs analysis and critical decision making. And we discussed about the product ideas, objectives, and how the product should be having a competitive advantage. And the market research needs to be performed to identify the potential users. SWOT and TOWS analysis has to be performed. And finally, financial planning has to be performed as well. And here are the references. And thank you so much for listening to me, and thank you again.